Good morning, traders. So this is Steve Ganz here. I've got a new concept trade that I'm going to share here. What I'm going to try doing in videos going forward as well, and I'm trying to figure out all the logistics of this, so this will be kind of a first run, is I want to break the videos up basically into three segments. The first segment is going to be the trade premise. In other words, what is it that what is my theory or my premise about the market or about a given stock? And then once I define the premise, then I want to look for the trade to apply to that premise and then go ahead and execute the trade and save the trade here in OptionStrat. So let me give you my premise here first this morning. So the premise is looking at a chart of Apple. Okay, Apple has recently taken a big hit through a number of things. Sales were off a little bit in China. They had some watch deliveries they couldn't do around the holiday season, etc. So all of that resulted in a pretty big drop in Apple. But let's look at where that drop came to from a technical standpoint. That drop came right down to these areas, these points that had previously been resistance. Of course, that resistance was popped through a little bit right here. But the bottom line is, if you were to extend this particular trend line that's been in place for quite a while, extend this line out a little bit, Apple pulled back right about to that trend line. The other thing to note is this dashed blue line here. This is the 200-day simple moving average. Now, the 200-day simple moving average is also kind of a major point where large institutions will often come in and look to start buying something, kind of like they did here. Doesn't mean it's not going to drop through that 200-day line, but it's kind of a signal to people that, you know, if you're looking at what has been a long-term bullish stock, that may be a logical point to consider a bullish position. Again, at a pullback to that 200-day moving average. So there's a couple of things coming into play, you know, right here, this support line that's in place, the 200-day moving average in place. We have seen that Apple has bounced off of that. Another piece of my premise here. This is a day where the S&P is down 31 points, okay? Let me come back to Apple here. When I clicked on the S&P, it went off that. Come back to Apple. And, you know, Apple is kind of holding up here today. Well, it's off a little bit, but it's not off as much percentage-wise as what the overall market is. So Apple's showing a little bit of what I'll call relative strength here. So all of those things are leading me into considering some sort of a bullish to neutral trade on Apple. If Apple stays in this general range of, 187 to 180, well, I want something that might profit from that. I also ideally might want something that would profit if Apple were to go higher. So if that's my premise, let's now start looking at trade selection. So when I come in and take a look at trade selection, again, I love the build function here. And I can look right here at two key bullish trades. I can do a bullish call spread, which is a debit spread. I would have to, pay for that. Or I can do a bull put spread where I'm selling a put and then buying a lower put. So how do I decide between these two? What are some of the differentiating factors? They're both bullish positions, but I'll tell you kind of a general rule of thumb that a lot of people use is they look at the volatility, okay? And let's come back here to Apple. These lines down here, this blue line is implied volatility. That's kind of a fear gauge in the market. When volatility is higher in a stock or in an index, that's when the price of options go up, particularly the put options. When people have a fear that, oh my gosh, I've got a whole bunch of Apple in my retirement account, I need to buy insurance on that. I need to protect that position. When people are in that position and starting to pay up or bid up the value of those puts, that's when I want to be a seller, okay? So if I look at this, I'm looking at maybe being a seller of a short put in the 180, 179 range, somewhere around there, because my premise is that if Apple comes back down to here, it probably isn't going to drop through there based on these things that I've already mentioned. Doesn't mean it won't happen. My premise is that it will come down and probably, or if it comes down, it probably will not fully drop through there. But I also have to plan for, if I'm wrong, you know, how much heat do I want to take on that position. So let's come back and plot out our position. So again, deciding the position, the trade selection, well, I don't really want to buy options. I don't want to buy a spread when volatility is higher because I'd be paying more for that. I want to be a seller. When people are fearful of a given thing happening and they're buying that insurance, I want to be the one selling that insurance to them. So we come in here, let's just take a look at Apple. And let me just tighten up my range here a little bit so we can see this full position. And I want to go out a little further than this in January 19th, but I do need to note Apple has earnings out here. That earnings are on February 1st. So I probably want to be out of that position prior to earnings. Again, it depends on whether you want to do what's called an earnings trade or not. In my case here, I'm going to say, yeah, I don't really know that I want to carry Apple through earnings at this point. So I can come in here and look at where do I want to sell my particular put spread, and what do I want to buy as my backup, as my protection on this put spread. So I can come in right to this general area here. Again, if my premise is that I don't really think it's going to go much below 180, I can sell the 180 put, and then I can buy some sort of closer put, a 177.5, you know, that does give me $200 in downside risk on this trade with potential profit of around $50. It's got a pretty high % chance of profit. So in other words, the calculations kind of indicate that this thing's probably a little more likely to stay above 180 than it is to drop below 180 mathematically. So that's certainly a good thing to look at. So now I could even, if I'm going to take in $50 in credit, I could even go a little higher on this and take in more money in credit. Again, maybe I still just want to leave this as a $2.50 spread. But here I've moved, you know, a little further closer to the money. When I get closer to the money, I will, in fact, get higher levels of premium for selling that put. But look what happened to my probability of profit. It did drop a little bit. So am I willing to trade that lower chance of profit for a higher credit that I'm going to take in? That's, again, something every trader needs to kind of consider. So let's just go back to where this was. So I'm going to take in $48, $200 in risk, 74% chance of profit, or I can take in $72, 63% chance of profit, and a little less risk. Of course, a little less risk because I took in a little more premium up here. Well, I think I like this one actually a little bit better. And yes, I am closer to the money at this point. My break even is just a little below 182. So in actuality, I need Apple to really kind of hold up above that 182 point in order for this to remain a profitable position. So I'm certainly taking some risk there. I get that. But based on, again, my premise of Apple staying probably above this 180 mark, I'm okay taking that risk. Now, I could also do one other thing here. I'm not going to do it in this particular, actually, I might do it in this particular trade. Let's model it out. Again, one of the great things about a program like this is that I can look at a bunch of different scenarios. So what if my scenario is that, okay, if Apple does rebound, I probably don't expect it to break above 190 again. What if I also hold that belief? Well, I can come in here and I can sell now a call, and I can sell that call at some point here. I'm going to just say 190, and maybe I buy a call above that to essentially turn this thing into some form of a condor. And I can have this condor with a broken wing or a skewed condor to where, now I only have $100 in downside risk. In exchange, of course, I've taken on a lot of upside risk. So this is something that I could potentially add to this trade, and as I'm looking at this, I'm actually kind of liking it. So I can look at something along these lines, and let me now just back this off to today so I could see what my T0 line looks like. I can see that this line here is fairly flat. This T0 line right here is relatively flat around this point. That's what tells me, I can now look at my Greeks. That's what tells me in my Greeks here, I'm slightly negative delta. So I'll make a little bit of money in this case if Apple drops. Maybe I want to be negative delta, maybe I don't. Again, I can adjust this trade accordingly, do something along these lines to turn it to positive delta, which again is probably based on my original premise that Apple's likely to maybe rebound up a little bit. I probably would be a little more comfortable with something with some slight positive delta in it. This also, selling this call spread up here, also increased my theta. We didn't look at that, but if I exclude these, we can see what my theta is. And theta is only 73 cents a day. By selling that call spread as well and turning this into a condor in this case, it's actually an iron condor because we are selling a put spread and a call spread. So by doing that, I have dramatically increased my theta. I've more than tripled my theta. Okay, so that's key for those of us selling options looking to generate income from that. My chance of profit didn't change dramatically, which is nice. But the amount of credit I'm taking in went from $70 up to $100. So again, in exchange for that, I did take on this upside risk. So if for some reason Apple rips and it rips up above 194, I will probably need to find a way to adjust this trade or close the trade. But for right now, I am actually going to do the condor. I came into this thinking that I was just going to do the put spread, but as I'm looking at the market here making lower lows, although Apple's holding up fairly well here, I also see this overhead resistance in this 187 range that I'm kind of thinking it's going to have a hard time busting through there. So I'm now playing for a range in Apple of essentially 190 to 180. That's kind of where I'm, this trade is expecting Apple to hang out for the next couple weeks. So I'm going to go ahead and save this trade. Again, I always am sharing trades that I want people to do in paper to learn how these things move and to learn the process of thinking about how do we decide a position, what position to open, etc. That's kind of the goal here, is to teach you how to use this valuable tool to evaluate all of these different things. So this is going to be one of the start to finish trades. And again, I'll save the trade. I'll share the link down below. Please give me any thoughts, comments, etc. I very much appreciate the opportunity to share this with you. And everyone take care. Have a great trading week.